Okay, guys, so welcome to today's class. So just a quick introduction of who I am and so forth. I'm not going to go into long details, but basically I'm Faiz and I'm here in Cape Town. Um, so I run a tutoring business called Eduhans, and we focus on accounting students, particularly accounting students that is in the third year university level, as well as the fourth year university level. So basically, we focus on aspiring chartered accountants, and we help them to pass their exam. So the way we do it is just basically, so in accounting, on the third year level, on the fourth year level, the volume of content is a lot, okay? And the concepts and stuff is really challenging. So for the volume, we just kind of simplify it, like really simplified. So so the large volume becomes a little. And then also we take the difficult concepts and we make it really easy for them to pass. So the way we basically do this is just following an approach, teaching people how to think through an accounting question, how to identify what the question is asking, and then using the theory to actually answer the question. So that no matter which question you get, whether you have seen it or have not seen it, you'll be able to answer it. So our focus is really on training you how to think. So I'm going to apply something similar, obviously on a much smaller scale when it comes to grade 12 accounting. But basically, I know the challenges that grade 12s have with accounting. Many grade 12s are scared of accounting. They fear accounting. They find accounting difficult. They find it challenging. They find it confusing. So we're gonna follow a similar approach, but obviously for a grade 12 level of to obviously teach you the theory and make you understand why you are doing what you are doing, and not just blindly doing calculations, not just blindly answering a question. So we're going to take that difficult concepts, we're going to make it really easy for you to understand. And then we're also going to show you how to think through a question, how to set up a question so that you save time. Okay, so that is basically what we're going to cover. So over the 4 lessons, we will work through question papers. So we'll work through the 2020 paper 1 and the 2020 paper 2. And as we answer questions, we will explain the theory. We will make you understand the difficult concepts, make it really easy for you to understand, and we will so that we will do, and then as we go through, we'll show you how to answer a question and how to think through a question. So that is basically going to be the process. And then what I will also be doing, I'll be writing out some notes for you, not over here, but I'll share it with you via email or via WhatsApp. We will share some notes for you to understand. So the most important aspect is really to understand what you are doing and not just doing it blindly. Okay, so that's going to be a big focus. And to do that, whether you are in high school, whether you are just doing a normal accounting degree, whether you are aspiring to be a chartered accountant, whether you are a professor, whether you are the CFO of a company, no matter who you are, when it comes to accounting and you find it challenging so in the real world, obviously transactions are a lot more complex. So you need to think through it really carefully. And how do you actually think through complex things? So obviously for for grade 12 students, grade 12 accounting appears difficult. When I was in grade 12, same thing, it appeared difficult. But what mechanism can you use in order to think through any question? So no matter who you are, which level, it all comes down to the accounting equation. So before we jump in, I'm going to show you how to use the accounting equation, how to understand the accounting equation to actually answer every single question that comes your way. Okay, so we're going to go through, we're not going to spend too much time, but we're going to go through understanding the accounting equation. We're going to go through understanding the income statement. What is the income statement about? And then we will work through one of the questions. Okay, so over the four lessons, we're going to work through 2 exam question papers. Okay, so before we move on, is there any questions that you guys may have? Let me just see. Jimmy, any questions? Kezia, your side, any questions? And Akisha, any questions your side? Nothing, yes, no? Are you okay? You can just give a thumbs up if you're okay. You can just put in the chat, you're okay? No, or just say you have no questions. Okay. Okay, so I'm going to switch over now into the whiteboard, okay? And then I'll explain to you guys the accounting equation, and then we will work through an exam question paper. I'm going to switch off my camera. Just okay, so you should be able to see you should be able to see the whiteboard. Okay. Okay, so you should be able to see the whiteboard. So I'm going to explain to you the accounting equation, and this is what you'll be using throughout your accounting exam, whether you are aware of it or not. Okay. So where is this now? So the accounting equation, we all know, is equal to assets equal, I think you guys say owner's equity, plus liabilities. What pin now? Okay, so assets equals owner's equity plus liabilities. Now, what you must be able to understand about this plays an important role. You need to ask yourself, what is an asset? Okay, so what is an asset? That's very important. What is an asset? For you to understand what is an asset, there's a whole definition of what an asset is. But just for our purposes, when you want to think of an asset, you must ask yourself, an asset, you must tell yourself, an asset is something that can still be used, can still, I'm going to change this. An asset is something that can still be used or it is something you can benefit from. Okay, so it's the same thing, but just put differently. So for example, so bank is an asset. What makes bank an asset? Bank has cash in it. So in future, you have cash to use. So that makes it, you make use of cash to that you can use in the future. That makes it an asset. With fixed assets, what makes fixed assets an asset is that in future you will benefit from it. You can use it to produce. So for example, at Coca-Cola, they have lots of machinery. Their machinery are classified as assets, I mean, as fixed assets. So fixed assets, what makes fixed asset an asset is that Coca-Cola can use the machinery to produce Coke. By producing Coke, they'll be able to sell Coke. By selling Coke, they can make money. That's the future benefit. So what makes fixed assets an asset is that fixed assets provide a company with future benefits. So I'll put it that way. It provides future benefits. So that is what you need to understand. What makes fixed assets an asset is that it provides future benefits. What are the future benefits? Like I explained with Coca-Cola, they have lots of machinery producing Coke. That machinery is fixed assets, which is classified as an asset. But what makes Coca-Cola's machinery an asset is that Coca-Cola use the machines to produce Coke. By producing Coke, they can sell Coke. By selling Coke, they make money. That is the future benefit. That's what makes fixed assets an asset. Same with cash. You can use cash to do whatever you want to. That makes cash a future benefit. That makes cash an asset. Okay, that's important. Same thing with prepaid expenses. What makes prepaid expenses an asset? It is that there's a future benefit. It is something you can still use. So let's just think about it. Let's say you have a cell phone and you go to the shop and you buy airtime. That airtime, technically speaking, from an accounting perspective, it is it's prepaid airtime. You first bought the airtime before you used the airtime. So that is a prepaid expense. Now, what makes a prepaid expense an asset? In order for something to be an asset, you must be able to benefit from it. So how can you benefit from it? Is that you can make phone calls. So in future, you can make phone calls. So that is what makes it an asset. Same with inventory. What makes inventory an asset? If you think about Foschini, if you think about Truworths, if you think about Woolworths, their clothing in the store is considered their inventory. Same if you think about Spar, if you think about ShopRite, if you think about Checkers, or you think about Pick and Pay, the groceries in the store, that is their inventory. So what makes inventory an asset? In order for something to be an asset, you must be able to benefit from it. What is the future benefit? The fact that they have inventory in the stores, it means they are able to sell. But when they do sell, they make money. So that money is the future benefit. So that's what makes fixed assets an asset. That is what makes inventory an asset. That is what makes prepaid expenses an asset. There's a future benefit. Similarly with debtors. What makes debtors an asset? In order for something to be an asset, there needs to be a future benefit. What is the future benefit? It's that people owe you money. So in future, you will be receiving money from your debtors. So that is the future benefit, that in future, you will get cash. So that is what makes debtors an asset. So it's very important to understand, why is something an asset? It is an asset if there is a future benefit. Okay, so that is basically what makes something an asset. And remember, whenever you look at something, you always ask yourself, is it an asset? Okay, you always start off with this side of the equation. So we always start off with this side of the equation. Okay, so we always start off with assets. Once you don't have an asset, once you can't see a future benefit, then we come to this side of the equation. Now, this side of the equation, you must start off with liabilities. Now, like assets, what makes something an asset? You need to ask yourself, what makes something a liability? How do you know you have a liability? So you have a liability if you will have a liability if you owe someone. So if you owe someone something, okay? Example, like cash. Okay, so if you owe someone cash. So for example, what makes creditors a liability? What makes creditors a liability? The fact that you owe creditors money, it means you have a liability. That is why creditors is a liability, because you owe the supplier money. What makes income received in advance a liability? What makes income received in advance a liability? It is because you received money, but you must still provide the service, or you must still provide the goods. That means whoever gave you the money, you still owe them the goods, you still owe them the service. So you owe them something. That is what makes income received in advance a liability. What makes accrued expenses a liability? The fact that you have used telephone, you have used water and electricity, but you must still pay for the telephone. You must still pay for the electricity and the water. So that means you owe the city, you owe Telkom for the telephone, you owe the city of Cape Town, or you owe the government, um, the municipality, you owe them the money for electricity, you owe them the money for water. So because you owe someone something, that makes it a liability. Same with a long-term loan. What makes a long-term loan a liability? You borrowed money, so you owe the bank the money. So therefore, because you owe the bank money, you owe someone something. That is what makes long-term loans a liability. So in accounting, the definitions are a lot more complex than this, but just for high school level, that is basically what you want to just know. So for an asset, if there's a future benefit, you have an asset. For a liability, if you owe someone something, that makes it a liability. So hopefully, by understanding this, you would be able to not get confused when it comes to the adjustments. Okay. So like we said over here, with assets over here, you first start, or when you have a transaction, you first start off and ask yourself the question, do I have an asset? Meaning, do I have future benefits? If the answer is yes, then you're dealing with assets. If the answer is no, then you will have to come to this side of the equation. When you are on this side of the equation, you need to ask yourself, do I have a liability? What makes something a liability? If you owe someone something. So whenever you owe someone something, automatically that is a liability. But if it's not a liability, then the only thing that we have left over is owner's equity. Okay, so it is owner's equity. Now, under owner's equity, there are two parts. Okay, so under owner's equity, we have two parts. The owner's equity has owner transactions. Owner's equity have two types of transactions, owner transactions and business transactions. So how do you know which one is which? How do you know which one is which? What makes owner transactions? What makes business transactions? Business transactions. So when we start off with assets, we ask ourselves, do we have a future benefit? If the answer is yes, we ask ourselves again, do we have another asset? Until the answer is no. Once the answer is no, then we come to this side of the equation and we start off with liabilities. How do we know that we have a liability? We have a liability if we owe someone something. But if we don't, then it must be owner's equity. So when we come to owner's equity, you must tell yourself owner's equity have two types of transactions. We have owner transactions and we have business transactions. So this plays a very important role because, you know, in grade 12, they're also strict on it. So you must be able to distinguish between what is an owner transaction, what is a business transaction. I'll go into more detail why that is important later, not now. But what makes something an owner transaction? You have an owner transaction is a capital contribution, like share capital. Okay, I know you did companies, then you have share capital. So that is a owner transaction. And the one that is very common to us is dividends. Okay, dividends paid, dividends declared. Okay, so dividends paid or declared. So a capital contribution is an owner transaction. Dividends paid or dividends declared, that is also an owner transaction. What's important, owner transactions must not be in the income statement. So owner transactions must not be in the income statement. The income statement only shows business transactions. So what are our business transactions? Our business transactions are expenses and income. So you have different types of income. So income is like sales, it is rent income, interest income. Okay, those are all income. Expenses is like cost of sales, rent expense, salaries and wages, depreciation, bad debts expense, all of those type of stuff. That is expenses. So income and an expense is a business transaction. Because it is a business transaction, that is why it is in the income statement. Capital contributions, dividends paid or declared is an owner transaction. That is why capital contribution and dividends paid and declared is not in the income statement, because owner transactions cannot be in the income statement. The income statement only has business transactions. So just be aware of that. Let's see what I want to do here. Okay. Okay, so that's just take note of that. Now we're going to do one last thing, and that is to know your debits and credits. Now, just to do it very quickly, okay, so remember what you might just know, that for every item we have a debit and we have a credit. So for every item we have a debit and we have a credit. Okay, so for assets we have a debit, we have credit. For owner's equity, we have debit and we have credit. Same for liabilities, we have a debit and we have a credit. Okay, so for everything we have a debit, we have a credit, a debit, a credit, a debit, a credit. Assets have a debit, a credit. Owner's equity have a debit and a credit. Liabilities have a debit and a credit. So now the question is, what debit, which side increases, which side decreases. Okay, so this is very important to understand. Which side increases and which side decreases. So how do we know? So just using basic mathematics, so I'm just going to show you. The way to think about it is as follows. Is that an asset increase on the debit side? All you must remember is that an asset increase on a debit side. All you have to remember is that an asset increases on the debit side. So if an asset increase on the debit side, automatically an asset decrease on the credit side. So all you need to know is that an asset increases on the debit side. So that automatically, because an asset decrease on the because an asset increases on the debit side, automatically it increases on the, sorry, what I'm saying, because an asset increases on the debit side, automatically it decreases on the credit side. Now, because we're dealing with, if you just look at this from a mathematics point of view, on this side, we have one thing, then we say equal to, and then we have equity and liabilities. Now in mathematics, when we take a positive and we take it to the other side of the equation, what happens? So when you have a positive on the one side and you take it to the other side of the equation, the sign changes. Okay, so I don't know if you, I'm pretty sure all of you cover maths. So I just basically, when we make something the subject of a formula and we rearrange an equation, when you take something to the other side of the equation, the sign changes. So if it is positive on this side, it will be negative on that side. If it's negative on this side, it will be positive on that side. So basically what we're going to end up with is that equity decreases on the debit side. Equity increases on the credit side. Same thing. Equity decreases on the debit side. Liabilities decrease on the debit side and liabilities increase on the credit side. And it all simply comes down to basic mathematics. So the only thing you have to remember is that an asset increases on the debit side. That's all you need to know. So once you know that an asset increases on the debit side, automatically an asset decreases on the credit side. Now, on the other side of the equation, you just switch the signs around because you're applying mathematics. So because on this side of the equation, a debit is positive, therefore on that side of the equation, a debit is negative. On this side of the equation, a credit is negative. So applying rules of mathematics, on this side of the equation, a credit will be positive. Okay, so that's just basic to remember. And you don't have to memorize it. All you have to memorize is that the asset increases on the debit side. Okay, so that's important to take note. So that's all I wanted to cover from an accounting equation point of view. Because as we go through the question now, we're going to be, whether you're aware of it or not, but I'll constantly throughout the different classes speak about assets increasing, speak about assets decreasing, and you must be able to know it is a debit, a credit, and all of those type of stuff. So now I'm going to switch over into the question paper, and we're going to work through part of the question paper in this lesson, and we'll continue it in the next lesson. We're finding where is this thing. Okay, so we're going to work through this question today. So we're not going to work through the whole one. What we're going to work through is part of question one. So question one is dealing with fixed assets and the statement of comprehensive income. So we will deal with the fixed assets part, and then next week we will deal with the statement of comprehensive income part. Okay, so that's what we're going to do. So we're going to be covering question 1.1, and we're going to be covering question 1.2. Then next week, we're going to work through this question over here, the statement of comprehensive income. And before the class next week, I will share with you guys some notes on what is it now called? Adjustments. Okay, so I need you to have an understanding of how adjustments work so that we can work a bit through it a bit quicker. But I'll share that notes with you next week. So today we're going to be working through these stuff over here, fixed assets. And what's going to be most important is that we're going to try to develop a way of how to think through fixed assets, because there's a few things we're going to have to understand in order to get to the numbers, but we basically going to try to work through that. So what I would like from you, if you have any questions, just stop me so that we so then you can so we can clarify anything that you may be confused about. Okay. So they start off the question. So here we have question 1, fixed assets and statement of comprehensive income. You can see it's 60 marks, 45 minutes. So what you're going to have to train is to make sure you can finish a question within time. But for now, the focus is more to get an understanding of how to do it. And then afterwards, we'll focus on writing it under time pressure. Okay, so it says the required 1.1, refer to information BA for fixed assets. Calculate the following. So we must calculate the missing amounts denoted by 1 to 3 on the fixed asset note. So you can see it's 11 marks. Then 1.12, calculate the profit or loss on the sale of equipment on 1 October 2020. And then they say refer to information BE for trading stock, calculate the trading stock deficit. Okay, so that's what we're going to be, that's basically what we're going to be covering. So for question 1, we must refer to information BA. Sorry, for question 1.1, we refer to information BA. For question 1.2, we refer to information BE. Okay, so that's important to take note. So let's have a look. So we're going to go to information B. Okay, so for information A, this over here we'll basically be using, mainly going to be using it for question 1.3. So let's start with BA. So we need to look at BA, which is all of this over here. Okay, so BA is all of this, up until there. Okay, so this is BA. As you can see, they're giving us an extract of the fixed asset note. We have vehicles, we have equipment. There is the missing number 1. There is number 2, and there is what number 3. Okay, so let's have a look. Let's read it first. So they're saying BA fixed assets. So fixed assets, they have vehicles. Under vehicles, we have 2 bullet points. What are the 2 bullet points under vehicles? So they say the business owns 2 vehicles on 28 February 2021. The second vehicle was purchased on 1 November 2020. Okay, so let's just make sure you understand what's happening. You can see the financial year end is 28 February 2021. So because the financial year end is 28 February 2021, 2021, what's important to take note is the following, that the beginning of the financial year is 1 March 2020. So it will be 1 March 2020 up until 28 February 2021. Okay, so it's very important to make sure that you include the, so it's very important to ensure that you know your financial year end. Okay, so now we know that the business owns 2 vehicles on 28 February 2021. The second vehicle was purchased on 1 November 2020, and they say vehicles are depreciated at 15% per annum on cost. Okay, for equipment, what do we know? That depreciation is 20% per annum on the diminishing balance method. They're saying unused equipment was sold for 40,000 Rand on 1 October 2020. Accumulated depreciation on the equipment sold was 36,600 Rand on 1 March 2020. Okay, so let's move on. So here we have the extract of, the fixed asset note. So at the beginning of the year, fixed assets is 460,000 Rand. Accumulated depreciation on at the beginning of the year, 1 March 2020, is 396,750. So what's important to understand, here we can have carrying value, there's a question mark. Basically, we must answer that number one. Now remember, what is carrying value? Carrying value is simply cost minus accumulated depreciation. So carrying value is cost minus accumulated depreciation. So therefore, this number one is an easy 2 marks. We're going to say 460 minus 396,750. Okay, so I'm going to switch over into Excel, and then I'm going to do the calculations within Excel, and I'll just share it with you guys. Okay. So let's have a look. So what are we going to do over here? Okay, so question 1.1. So question 1.1, I just want to see where is this now. So question 1.1, here we can see question 1.1. We're going to be covering this information. So question 1.1.1. So question so I is as follows. Okay, so question 1.1.1I, they asked us to get I. I is sitting by the carrying value at 1 March 2020. So it is carrying amount of vehicles at 1 March 2020. So now here's the important aspect. What is carrying value? Carrying value is simply cost minus accumulated depreciation. So carrying value equals cost minus accumulated depreciation. Okay, so what is cost? What is accumulated depreciation? So to get it, we're just going to say cost accumulated depreciation okay, I'm just gonna do it quickly. So therefore, carrying amount equals. So what is cost price? So over here, we can see cost price is 460,000. Cost price is 460,000. And accumulated depreciation was given to us as 396,750. 396,750. So whatever that answer is, I'm just going to work it out over here, then we can see what the answer is. So it's 460, and it is 396,750. So carrying value is simply going to be 460 minus 396,750. Okay, so that is carrying value. So let's have a look at number 2. So number 2 is asking us to work out, depreciation. So number 2 is asking us to work out depreciation of vehicles. So remember, when it comes to vehicles, we know there was a vehicle that was purchased on 1 November 2020. So we're going to have old vehicles and we're going to have a new vehicle. So the old vehicles is simply going to be the 460 using the 15% depreciation rate. And then we're going to work out the depreciation on new vehicles also at 15%. So let's go and work that out. So if we work out 1.1.1, which is 2, we want to work out depreciation. We want to work out depreciation. We want to focus on new. We want to focus on sold, and we want to focus on old. Now, when it comes to vehicles, there nothing was sold. So therefore, there's nothing for sold. So I'm going to remove it. So for the new, what do we have? For the new, all we're going to do is as follows. Take the cost of the new vehicle. So it's cost price multiplied by the depreciation rate multiplied by time. Okay, how many months have we used it in the current year? So how many months have we used it in the current year? So in our case, cost is 510. How do we get the 510? If we have a look over here, we under additions, we acquire, additions refers to the cost of assets that we have bought during the current year. So that is the 510,000. We're going to multiply by the depreciation rate. Vehicles is at 15% per year. But remember, we only acquired this on 1 November. So therefore, we never had it for the full 12 months. So the way we're going to do it is as follows. We're going to say, we're going to count the number of months we have used depreciation in the current year. So when we have a look at depreciation, we want to calculate the number of months. We're going to start off from the date we acquired it, which is November, December, January, February. So we have it for 4 months out of the 12 months. So we're going to say multiplied by 4 divided by 12. So if we want to work it out, we're going to say 510, 1, 2, 3, multiplied by 15%, multiplied by 4 divided by 12. So the depreciation for the new vehicle is, whatever this answer is, let's just have a look, is 25,500 Rand. Now for the old vehicle is just basically, I call it old. Old just means the ones we had there from the beginning of the year and is still there at the end of the year. So that's going to be fairly simple. We're going to use the same formula. We're going to use the same formula. In this time, the cost price is 460, because that is the cost of assets that were there at the beginning of the year and are still there at the end of the year. So that's 460,000 times the depreciation rate of 15%, multiplied by time. We had it for the full year, so it's 12 divided by 12. So the answer over here is going to be 460, 123, multiplied by 15%, multiplied by 12, divided by 12. So the depreciation So therefore, total depreciation is as follows. So it is that plus that. Okay, so 94,500 will be the amount that you include in 94,500 is the depreciation that we will include over here. So what we will include over here is that 94,500 Rand, and we'll put it inside of brackets because depreciation is negative. It decreases the amount of fixed assets. Now, the last thing we're going to cover is this over here. Question 1, to work out the disposals at carrying value. So we want to work out disposals at carrying value. Remember, when you dispose of an asset, so we disposed of an asset on 1 October 2020. So we disposed of an asset on 1 October 2020. Okay. So what we're going to do over there, we need to work out what is the carrying value at the date of disposal. So what is the carrying value at 1 October 2020? Now remember, what is carrying value? Carrying value is cost price. Carrying value is cost price minus accumulated depreciation. So let's go and work that out. So when we want to work out the disposal amount, so it is 1.1.1, number 3. So what we're going to work out over here is the disposal amount. Now, when we work out a disposals, disposal amount is always at carrying value. But very important, it is the carrying value at the date of disposal. It is the carrying value at the date of disposal. Okay, so when did we dispose of? So date of disposal. Date of disposal is 1 October 2020. So that means we need the carrying value at 1 October 2020. Therefore, we need the carrying value at 1 October 2020. Okay, so that's important to understand. So how do we calculate carrying value? So carrying value is cost. So carrying value, you can just use the formula here above. carrying value, so use the formula above, carrying value equals costs minus accumulated depreciation. Okay, so we want cost and we want accumulated depreciation. And the accumulated depreciation, we want accumulated depreciation at 1 October 2020. So 1 October 2020, and that will give us our carrying value at 1 October 2020. So this will give you carrying value 1 October 2020. This is extremely, extremely important. So this is extremely, extremely important. Now, how do we get accumulated depreciation at 1 October 2020? In this example, they gave us the accumulated depreciation for the asset that was sold at 1 March 2020. So we have the depreciation, we have the accumulated depreciation on 1 March 2020 for the asset that was sold. But remember, we don't want accumulated depreciation at 1 March. We want the accumulated depreciation at 1 October. So how do we get that? Okay, so to get the accumulated depreciation at 1 October 2020 for the asset sold, we do the following. So what do? We start off with accumulated depreciation. We start off with accumulated depreciation at 1 March 2020. Then we add, we say plus depreciation. Then we add depreciation from 1 March 2020 to 1 October 2020. Now, what was the accumulated depreciation at 1 March 2020? So here they're telling us unused equipment was sold for 40,000 Rand on 1 October 2020. Accumulated depreciation on equipment sold was 36,600 on 1 March 2020. So we know that. So what do we know? That on 1 March 2020, the accumulated depreciation for the item sold was 36,600. But to get the accumulated depreciation at 1 October 2020, do this quickly. So to get the accumulated depreciation of the sold item at 1 October 2020, what we will have to do is add the two amounts together. But that means we're going to have to calculate depreciation. Now, to calculate depreciation using the diminishing balance method equals. So depreciation, see if I spelled it correctly. So depreciation using the diminishing balance method equals as follows. Cost price minus accumulated depreciation. Cost price minus accumulated depreciation multiplied by rate multiplied by time. Okay, so using the diminishing balance method, we say cost price minus accumulated depreciation multiplied by the rate multiplied by time. Now, we know, so we'll say depreciation equals. Okay, so that means we need to get cost price. How do we get cost price? Now that is, we'll be able to work that out. Here you can see we have cost price on 1 October 2020, on 1 March 2020, and then we have cost price on 28 February 2021. So you can see it went from 360 to 285. We never bought any new items. So therefore, the difference between the two would be the cost price of the equipment that was sold. So all we're going to do, the cost price that was sold is simply going to be 360 minus 285. Okay, and that is equal to, let's just see, it's equal to 360 minus 285. It is equal to 75,000 Rand. So therefore, what we're going to get over here, the cost price is 75,000 Rand minus accumulated depreciation at the beginning of the year. So the accumulated depreciation at the beginning of the year, that was given to us as 36,600. We know the depreciation rate using the diminishing balance method for equipment is 20%. Now we must work out how long we have used the equipment that was sold in the current year. So we sold it on 1 October 2020. Therefore, we used it from 1 March, April, May, June, July, August, September. We have used it for 7 months. So we say multiplied by 7 divided by 12. So this answer would be as follows. So the depreciation would be as follows: 75,000 minus 36,600 multiplied by 20% multiplied by 20% multiplied by 7 divided by 12. So the depreciation is 4480. So therefore, okay, so therefore accumulated depreciation at 1 October 2020 is that plus that. So therefore accumulated depreciation at 1 October 2020 is 41, and we know the cost price is 360 minus 285. So therefore the cost price is 360 minus 285. So the carrying amount is cost price of the item sold, which is 75,000 Rand, minus accumulated depreciation at 1 October 2020. Why 1 October 2020? That is the date when the equipment was sold. Very, very important. So there we go. So therefore, the carrying amount is 33,920. So that's the answer. Okay. So let's go back to the required. And now we must do 1.1.2, the profit or loss on the sale of equipment. So that's a very quick calculation. Profit or loss. Profit or loss, 1.1.2. Profit or loss equals cash minus carrying amount. So we know the cash was 40,000 Rand. So we know the cash was, we sold it for 40,000 Rand minus the carrying amount. We know the carrying amount is 33,920. Okay, so therefore the answer is going to equal 40,000 minus 33,920. Okay, so it's 6,080. So because we sold it, because the amount that we sold it for is more than the carrying amount, we're making a profit. So therefore, it is profit of 6,080. Okay, so because the amount we sold it for is more than the carrying amount, it is a profit. If the amount we sold it for is less than the carrying amount, then it would have been a loss. Okay, so that's all that I'm going to cover in this class. We will work through more questions next week. Okay, thank you very much.